I want you to just close your eyes for a second, right? And imagine the internet back in like the late 1990s.
Oh man, the dial-up era.
Yeah, exactly. Think about those screeching dial-up tones, the incredibly slow load times, and just the sheer teeth-grinding frustration of watching a single low-resolution image load, like line by line.
Top to bottom, taking a full minute.
Right. People used to joke that the www in the web address actually stood for the World Wide Wait.
Which was painfully accurate at the time.
It really was. So imagine a company that looked at that chaotic, fragmented mess of early internet architecture and decided to basically build the municipal water system for it.
Right, like laying down the actual pipe.
Exactly. They laid down the invisible pipes, the caching servers, the delivery networks that made websites actually load fast, regardless of where you lived. And for decades, they were this quiet, invisible utility company of the web.
You never thought about them.
Never. You probably didn't even know their name, but you relied on them every single time you clicked a link.
They were the ultimate behind-the-scenes player, really. A company entirely built on the premise of making sure digital traffic is reliable, scalable, and mostly just fast.
Fast, yeah.
By, keeping the data as close to the end user as physically possible.
Right, so fast forward to 2026. Imagine I told you that this exact same legacy delivery network company just signed a $1.8 billion contract with a leading AI frontier model company.
It sounds like a typo, honestly.
It does. I mean, You're talking about a massive streaming service or an online retailer needing faster image loading here.
Right.
We are talking about a cutting-edge artificial intelligence company trusting their core infrastructure to the old plumbing company of the internet.
Yeah.
Like, how does a legacy content delivery network suddenly transform into a titan of the artificial intelligence revolution?
Well, I mean, it represents one of the most drastic and frankly high-stakes corporate transformations we've seen in modern tech history. Because moving from routing static images and video files to processing the most complex computational tasks humanity has ever devised, it's not a natural evolution.
No, it's a massive leap.
Right. It requires a fundamental rewiring of the entire business model.
So welcome to this deep dive. Our mission today is to dissect a very specific, incredibly revealing moment in time, which is the Q1 2026 earnings call of Akamai Technologies.
Ticker symbol AKAM.
That's the one. We are taking the actual transcript, like the raw source material of this call, and we are going to break it down. We're going to examine the headline numbers, the aggressive capital allocation strategy, and just this wild technology pivot they are executing.
Moving from basic content delivery to distributed AI inference and next-generation cybersecurity.
Right. So we'll be analyzing statements from the key architects guiding this transition. That includes Dr. Tom Layton, the CEO of Akamai, Ed McGowan, the Chief Financial Officer, and Mark Stoutenberg from Investor Relations.
And they are laying out a very specific, highly expensive, and just incredibly ambitious roadmap. It really challenges how we think about the future of global computing.
It does. But before we get into the wild AI technology and the massive global deployment of thousands of GPUs and the, frankly, terrified cybersecurity experts dealing with unprecedented threats.
Which is a whole story in itself.
Oh, it's huge.
Yeah.
But we have to ground ourselves in the reality of the business first. We have to start exactly where Wall Street starts, right? The cold, hard headline number.
The financials.
Exactly. So looking at Q1 2026, Akamai reported a top-line overall revenue of $987 million.
Right. And when you look at that $987 million figure, it represents a 6% year-over-year growth as reported, or 4% in constant currency.
Okay, so 6%.
Yeah. For a mature, established company, that kind of steady mid-single-digit growth is solid, but it certainly doesn't scream AI revolution,
Right, so it's kind of boring.
Exactly. However, to understand what is actually happening inside Akamai today, you have to peel back that top-line number. You have to realize they are no longer operating as a monolith.
Okay.
They are managing 3 very distinct business pillars, and those pillars are moving in completely different directions at very different speeds.
So let's break those pillars down for you listening, because this is how you spot a massive corporate pivot playing out in real time on a balance sheet.
Yeah.
First, you have their legacy business, which is delivery and other cloud applications. This is the content delivery network, the CDN.
The original invisible plumbing we talked about.
Right. In the first quarter, this segment brought in $389 million.
Mm-hmm.
But here is the critical data point. That number is actually down 7% year over year.
And down 8% if we are looking at constant currency.
Wait, let me pause you right there, actually. We hear the term constant currency thrown around on almost every global earnings call, but I want to make sure we are totally clear on the mechanics of that. Why does Wall Street care so much about constant currency?
Well, it's a vital metric for understanding the actual health of a global business because Akamai operates all over the world, right? Meaning they generate revenue in euros, Japanese yen, British pounds, dozens of other currencies.
Right.
But when they report their earnings, they have to translate all of that money back into US dollars.
Oh, I see.
So if the US dollar happens to be exceptionally strong compared to those other currencies during that specific quarter, the overseas revenue will look smaller when it's translated back, even if they sold the exact same amount of services.
Oh, interesting.
So constant currency is just a mathematical adjustment. It strips out those fluctuating foreign exchange rates. It allows investors to see the fundamental growth or decline of the actual business operations, isolating it from the noise of, global currency markets.
Okay, that makes a lot of sense. So looking at the actual operations, the delivery business is shrinking.
Yes.
But Ed McGowan, the CFO, he addressed this head on during the call, right? He didn't seem panicked about the legacy business contracting.
Not at all. I mean, he contextualized it by noting these results were entirely in line with their internal modeling.
Okay.
He explained that a significant portion of the decline was driven by the wraparound impact of something they called the EGO transaction from 2025.
Okay, more corporate jargon. Let's translate that for everyone. A wraparound impact just means that a year ago, they either bought something, sold something, or had a one-time financial event, in this case related to EGO, that artificially bumped up the numbers in Q1 of 2025.
Exactly.
So when you compare Q1 2026 against that artificially high baseline from last year, it looks like a steeper drop than it actually is.
That is the perfect way to look at it. You just have to pass the one-year anniversary of the event for the year-over-year comparisons to normalize. And McGowan projected that this rate of decline in the delivery segment is going to moderate throughout the rest of the year as those comparisons smooth out. They expect it to continue declining, but at a much slower, controlled pace.
So they've planned for this.
Yeah, they have modeled the shrinkage into their master plan.
The old empire is slowly deflating.
Yeah.
But then you look at pillar number 2, which is security. This segment generated $590 million in the quarter. It is now, by a massive margin, their largest overall revenue driver.
Yep.
And unlike delivery, it is actually growing. It was up 11% year over year, as reported.
Because security is the bridge, really. Think of it as the financial life raft that kept the company growing while the legacy delivery market became saturated and commoditized.
Oh, that makes sense.
Right, because every time a company used Akamai's network to deliver content, it made perfect sense to also buy a firewall or threat protection from Akamai to secure that exact same content.
It's an easy upsell.
Exactly. So security took over as the cash cow. But as impressive as a $590 million growing security business is.
And it is impressive.
It is, but it's not the main event of this call.
Mm-hmm.
The real star of the show, like the narrative engine driving the entire future of the company, is pillar number 3, which is cloud infrastructure services, or CIS.
This is the cloud compute business.
Yes.
And they reported $95 million for CIS in Q1. Now, just looking at the raw dollars, $95 million sounds relatively small compared to a $590 million security business, right?
Right.
But the growth rate is where the story shifts dramatically, because that $95 million represents a staggering 40% year-over-year growth.
40% as reported and 39% in constant currency. And honestly, the most vital piece of context from the transcript is that the pipeline of future customers for this segment is building at an unprecedented rate. So if you step back and look at the whole board, you have a maturing, shrinking delivery business, a steadily growing, massive security business, and a hyper-growth cloud computing business that is effectively operating like a Silicon Valley startup trapped inside the body of a legacy tech giant.
Trapped inside a utility company.
Exactly.
But operating a hyper-growth startup inside a legacy company creates intense financial friction.
Always.
Because growth of that magnitude requires a massive amount of capital. And this is where I start to see a tension in the numbers that I want to explore. Let's look at profitability.
Okay.
They reported non-GAAP net income of $239 million, which translates to $1.61 per diluted share. But that earnings per share figure is actually down 5% year over year.
Right.
So think about this from an investor's perspective, right? Your traditional business is shrinking. Your overall profit is actually down 5%. But your new experimental cloud business is growing at 40%. Is this a healthy, controlled transition? Or are we watching a company bleed its core profits just to chase an AI trend?
It is a calculated, aggressive, and admittedly painful financial transition because CFO Ed McGowan did not hide from that 5% drop in net income.
You brought it up.
He addressed it directly. He explained that Akamai is intentionally suppressing its own profitability right now to fund this pivot. Their non-GAAP operating margin for Q1 came in at 26%.
And normally, what is it?
Well, historically, software and delivery businesses run much higher margins. Why is it down to 26%? Because of strategic, heavy investments in the physical world.
Okay, what kind of investments are dragging down the margins that heavily? I mean, software shouldn't be that expensive to scale.
Well, it's not just software anymore. McGowan listed 3 primary drivers. First, aggressive expansion of co-location space. That means they are out in the market leasing physical floor space, power, and cooling capacity in massive third-party data centers all around the globe.
Got it. Real estate, basically.
Digital real estate. Second, they are absorbing higher depreciation costs from buying hundreds of millions of dollars worth of physical hardware.
Okay.
And third, they are dramatically increasing their headcount, hiring specialized engineers and sales teams who actually understand the complexities of AI and cloud infrastructure. Every single one of these expenses is specifically tethered to their strategy to capture the massive cloud infrastructure services market.
Let me drill down into the depreciation aspect for a second, because I think it helps illustrate just how dramatically the business model is changing.
Yeah, let's do it.
Because when Akamai was purely a software and delivery network company, they had relatively low capital expenditures, right?
Right.
But now they are buying cutting-edge physical hardware. And if you buy a server or a highly specialized AI graphics processing unit, a GPU, it loses value over time, just like driving a new car off the lot.
Yes. The accounting mechanism for that loss of value is depreciation. If you spend millions of dollars on specialized NVIDIA GPUs today, you have to acknowledge on your income statement that those assets are aging and becoming less valuable every single month.
So it drags down the profit on paper.
Exactly. That depreciation acts as a massive anchor on your reported operating margins. So McGowan is effectively telling Wall Street, look, we are accepting lower profits today because we are buying the concrete, the steel, and the silicon required to build an entirely new global network.
They are trading short-term, quarter-by-quarter profitability for a foothold in a total addressable market that is exponentially larger than anything they've ever competed in before.
Betting the farm.
They are totally betting the farm. But to truly grasp why the management team is so incredibly confident, like why they're willing to take that margin hit and risk the patience of their traditional dividend-seeking investors, we have to look at the catalyst.
It's a big deal.
Yes, we have to look at the $1.8 billion mega deal that redefines their entire trajectory.
I mean, it is the single largest transaction in the history of the company. It completely dominated the narrative of the earnings call.
Yeah, so in the opening remarks, CEO Tom Leighton drops this massive announcement. He says they successfully negotiated and signed a landmark 7-year, $1.8 billion commitment for their cloud infrastructure services.
Huge.
But the client is completely unnamed in the transcript. They refer to them only as a leading frontier model company.
And that phrasing, frontier model company, is critical because it implies this isn't just, a random app developer. It is an organization actively training and running the foundational next generation AI models that will power the future of the technology.
Right.
Earning the trust of a company at that bleeding edge of computer science is a massive external validation of Akamai's new cloud architecture.
Yeah, it proves they can play with the big kids.
Exactly. And it is important to note this deal wasn't an isolated fluke either. It came right on the heels of another major announcement from February where they secured a $200 million deal with a different major U.S. tech company also operating at the forefront of the AI space.
So if I'm an analyst sitting on this earnings call, hearing the words $1.8 billion definitely gets my attention.
Oh, absolutely.
But the immediate follow-up question has to be about the mechanics of the cash flow, right? Because a multi-billion-dollar deal sounds fantastic on a press release, But how does that money actually move from the AI company's bank account into Akamai's revenue column? They aren't just cutting a check for the full amount on day one, are they?
No, not at all. And the structural mechanics of the contract are fascinating. They were actually the primary focus of analysts like Mike Sickos from Needham and John DiFucci from Guggenheim during the Q&A session.
What do they ask?
Well, the most vital distinction that the Akamai team made is that this is not a traditional consumption-based deal.
Okay, let's clarify the difference for the listener. Because when most of us think about cloud computing, we think of the massive hyperscalers like Amazon Web Services or Microsoft Azure,
Right.
And their core model is consumption-based. Like if I log into AWS and spin up a virtual server to run a database for exactly 4 hours, Amazon bills me for exactly 4 hours of compute time.
Yeah.
If I turn it off, I stop paying. It's like pay-as-you-go electricity.
That is the standard hyperscaler model. But this $1.8 billion deal operates on an entirely different philosophy. It is a dedicated capacity deal.
Dedicated capacity.
Right. The Frontier Model Company is not paying by the hour. They are paying for a massive, locked-in, guaranteed amount of server and GPU capacity that belongs exclusively to them for the next 7 years.
They're essentially renting an entire neighborhood of digital real estate, not just booking a hotel room for the night.
That's a great way to put it. And because it is dedicated capacity, CFO Ed McGowan explained that the financial recognition operates almost exactly like a massive software subscription.
Awesome.
Once Akamai finishes the physical build-out, installs the hardware, and officially turns the capacity live for the customer, the revenue begins to flow. They will recognize the $1.8 billion ratably, which just means in equal, steady installments over the 7-year life of the contract.
Oh, steady, predictable, recurring revenue.
Wall Street loves that.
They do. But when does that revenue actually start hitting the income statement?
Right.
Like if they sign the deal in early 2026, are they seeing the benefit immediately?
No, because you have to build the infrastructure first, right? McGowan noted they anticipate the revenue to officially start ramping up in the fourth quarter of 2026. For that specific quarter, Q4, they expect to generate roughly $20 to $25 million from this specific deal alone.
Okay.
And from there, it will scale up fully into 2027 and run continuously for the remaining 6+ years of the agreement.
Okay, so the recurring revenue is the dream scenario. But here is where the reality check comes in. To get access to that $1.8 billion river of cash over the next 7 years, Akamai has to front the money to buy the actual physical computers.
Yep.
And the capital expenditure, the CapEx required to fulfill this contract is absolutely breathtaking.
It fundamentally alters their balance sheet because McGowan laid out the timeline with brutal clarity. To support the capacity requirements for just this one single unnamed customer, Akamai must spend approximately $800 to $825 million over the next 12 months.
Wow. Let's just sit with that number for a second. Over $800 million of cash out the door just to buy the hardware to service one client.
Yeah.
They're planning to deploy roughly $700 million of that capital in the second half of 2026 alone, with the remaining balance falling into the first half of 2027.
It is a phenomenal outlay of upfront capital for a company that, built its empire on asset-light software routing.
I have to put on my skeptical investor hat here. That sounds incredibly dangerous.
Oh, it is.
Because if you commit to a 7-year fixed price contract, but you still have to go out into the open market and buy $800 million worth of hardware over the next year, aren't you exposing yourself to massive supply chain risk?
Totally.
The global market for AI hardware, specifically high-end memory and GPS, is notoriously volatile. We've seen massive shortages and sudden price spikes before.
Many times.
So what happens if the cost of the raw physical silicon skyrockets before Akamai can actually purchase all the equipment they need? Do they just eat the loss and destroy their margins entirely?
It is a very astute concern, and honestly, it is precisely the vulnerability that John DiFucci from Guggenheim zeroed in on during the Q&A. He asked management point blank about their exposure to higher memory costs.
Oh, he did?
Yeah. He wanted to know if a sudden spike in hardware prices can turn this massive deal into a massive liability over the next year.
Good question. How did McGowan defend the strategy? Did they lock in the hardware prices beforehand?
Well, McGowan's response was designed to completely neutralize that fear. First, he highlighted the logistical preparation. He stated that his team worked incredibly closely with the hardware vendors long before the deals even signed.
Okay.
So they have the massive supply chain pipeline prepped and ready to deliver the goods over the next 12 months. But more importantly, regarding the financial risk of a sudden price shock, he revealed a critical clause in the contract.
Ah, the escape hatch.
Exactly, the escape hatch. He stated they have contractual mechanisms built into the agreement with the Frontier Model Company to deal with unpredictable price fluctuations.
Oh, wow.
Yeah, so if the cost of raw components or GPUs inexplicably surges 6 months from now, the contract contains provisions allowing Akamai to adjust the pricing parameters to absorb and pass on that shock.
So the client takes the hit, not Akamai.
Basically. The catastrophic downside risk of a broken supply chain destroying the profitability of the deal has been legally mitigated.
Okay, that is a massive relief for any shareholder listening to the call. So they have the supply chain lockdown, they have pricing protection in the ink, and they have $1.8 billion in guaranteed revenue lined up over the next 7 years.
Sounds pretty good.
It does. But it begs a much larger structural question about the tech industry right now. We know what they sold, right? Dedicated compute capacity. We know how much they sold it for. But why did this cutting-edge, world-class AI company choose a legacy delivery network like Akamai?
Right.
If you are a leading AI company with billions of dollars, why wouldn't you just go to the massive established hyperscalers? Why not just hand the contract to Amazon, AWS, Google Cloud, or Microsoft Azure? What does Akamai have that the giants don't?
That is the multi-billion-dollar question, and the answer reveals the entire strategic thesis of Akamai's pivot. It actually requires us to move away from the financial statements for a minute and look at the actual physical architecture of the global internet.
Okay, let's do it.
Because the reason a leading AI company bypassed the hyperscalers and chose Akamai comes down to the physics of geography and the strategic importance of what the industry calls the edge.
The edge. Right, so let's talk about the physical architecture of this new network. Because in his prepared remarks, CEO Tom Layton continually referenced a major technological announcement they made in March at GTC.
Right, NVIDIA's massive industry-defining GPU technology conference.
Exactly. And they utilize that stage to unveil what they are calling the industry's first global-scale implementation of NVIDIA's AI grid.
It was a very deliberate show of force. They announced the deployment of thousands of highly specialized NVIDIA RTX Pro 6000 GPUs.
Thousands of them.
But the revolutionary aspect of the announcement wasn't just that they bought a massive pile of fast microchips. You know, anybody with enough capital can buy chips.
Right.
The differentiation is entirely about where they are physically installing those chips.
Location, location, location.
Yeah.
Tom Layton laid out a core philosophical thesis for the future of artificial intelligence computation on this call. He firmly believes the industry is moving past the era of what he calls isolated AI factories.
Yeah, and the term isolated AI factory is a direct shot at how the massive hyperscalers currently operate.
Right. Because if you picture traditional cloud computing for AI right now, it looks like a gargantuan, sprawling warehouse sitting in the middle of a remote desert somewhere, right?
Exactly.
Giant, centralized data centers packed with tens of thousands of servers, drawing insane amounts of electricity, located hundreds or thousands of miles away from the people actually using this service.
Yeah.
That is the AI factory model.
Right, and it makes sense for the training phase of AI. Like, when you are building a massive language model, you need all the data and all the compute power aggregated in one single location where land and electricity are cheap. You just let the supercomputer run for months to learn the patterns. But Layton is arguing that the market for actually using the AI, the process we call AI inference, cannot survive on that centralized model.
No.
No, it must shift toward a unified, highly distributed grid.
I think an analogy really helps visualize the difference here.
Yeah, let's hear it.
So if a traditional hyperscaler cloud environment is like a massive, incredible mega mart located in the absolute geographic center of the country. It has unlimited inventory. It has everything you could ever possibly need, but you have to drive 3 hours just to get there and 3 hours to get back down.
Right.
Akamai is taking a different approach. They are essentially building thousands of highly specialized, super fast convenience stores on every single corner, in every single neighborhood.
I like that.
They don't hold the entire inventory of the world, but they have exactly what you need right when you need it. So your AI agent doesn't have to commute across the country to answer a simple question.
Exactly. And in the realm of computer science, the duration of that commute is measured in latency. Because the physical distance data has to travel through fiber optic cables is constrained by the literal speed of light.
You can't beat physics.
You can't. By integrating NVIDIA's specialized infrastructure directly into Akamai's pre-existing massive global content delivery platform, they are pushing the computational power out of the centralized desert and directly to the edge of the network.
And how big is that footprint?
We are talking about a footprint of 4,300 locations spanning across 700 different cities in 130 countries.
That's massive. But let's connect that abstract concept back to the everyday listener. Why does latency matter for an artificial intelligence? Like, why does it matter if my data takes a millisecond versus a full second to travel back and forth?
Okay, imagine you are interacting with a highly advanced personalized voice, AI agent on your smartphone. You ask it a complex question.
Right.
If that audio file has to travel from your phone in London under the Atlantic Ocean all the way to a centralized data center in Virginia to be processed by a GPU, and then the generated audio response has to travel all the way back under the ocean to your phone, there is going to be a noticeable delay.
Like a lag on a video call.
Exactly. It might only be half a second, but in human conversation, a half-second pause makes the AI feel sluggish, unnatural, and kind of robotic. It ruins the illusion of intelligence.
It creates friction in the user experience.
Precisely. But if that same AI model is running on an Akamai server located just a few miles from your apartment in London, the data only travels across the city. The response is virtually instantaneous.
Wow.
Leighton emphasized that this massive geographic distribution allows their customers to run complex AI inference models within milliseconds of their end users. It provides the blinding responsiveness of local computing with the massive scalable power of the global web. The hyperscalers simply cannot match that level of local proximity because they don't have facilities in 700 different cities.
They just don't have the real estate. And the market is clearly validating this thesis too. The proof is in the contracts. Leighton used the call to rattle off a list of specific use cases and enterprise clients they've already won just since the beginning of 2026.
It really feels like a global land grab for edge compute.
It is a gold rush, and they are providing the shovels at every local outpost. He mentioned a consumer AI platform based in the US that is currently utilizing Akamai's edge network to run and scale live, personalized AI agents for their users.
Yep.
He highlighted a major AI commerce company in India that is relying on Akamai to power a highly complex ad personalization engine, which, requires instantaneous decision-making to serve the right ad to the right user in real time.
Right, milliseconds matter there.
But the use case that stood out the most to me was the AI-powered video platform in India.
Oh, that was fascinating.
They chose Akamai's GPU platform specifically to scale their computer vision and video analytics software for large retailers. Just think about the mechanics of that. If you are a retailer with dozens of high-definition security cameras running real-time AI to analyze foot traffic or prevent theft, you cannot stream dozens of raw, uncompressed 4K video feeds halfway across the world to an AI factory.
The bandwidth costs alone would bankrupt you.
Exactly. And the latency would make the real-time analysis completely useless. You fundamentally require the heavy computing power to sit right there in the local city, just a few miles from the cameras.
It is a hard physical limitation. You need the scale of a massive cloud provider, but you need the localized proximity of an on-premise server. And Akamai is uniquely positioned to offer exactly that hybrid solution.
Right. Now, during the Q&A, an analyst named James Fish from Piper Sandler brought up a fascinating pushback regarding this highly distributed architecture.
I remember this.
And it touches on the single biggest bottleneck facing the entire technology sector right now, which is power consumption.
Power grids are literally the limiting factor for the AI revolution.
They are. Artificial intelligence computation requires so much electricity that the major tech companies are openly discussing investing in or even restarting dormant nuclear power plants just to feed their centralized data centers.
It's an energy crisis in the making, really.
So James Fish looks at Akamai's plan, does some back-of-the-napkin math, and asks a very pointed question. He looks at those 4,300 locations and asks, basically, how on earth are you securing the power for this? How do you have the megawatt capacity to run thousands of industrial GPUs globally without constantly tripping the breakers and fighting with local utility companies?
Because Fish estimated that if Akamai's larger compute sites use 5 to 10 megawatts of power each, it would push their total network requirement well over 300 megawatts.
Which is a massive draw.
It is. He wanted absolute assurance from management that they had successfully secured and allocated enough raw power specifically for this massive new $1.8 billion hardware-heavy contract.
It is the billion-dollar logistical question. You can't just plug a rack of thousands of RTX 6000 GPUs into a standard wall outlet. The cooling requirements alone are staggering. So how did CFO Ed McGowan navigate the power grid question? Are they going to hit an absolute wall where they simply can't find enough electricity to turn the servers on?
Well, McGowan was incredibly confident about this, and his answer highlighted a structural advantage of their distributed model.
Okay, what is it?
First, he respectfully corrected Fish's back-of-the-napkin math, clarifying that the actual power required to fulfill this specific frontier model deal is significantly lower than Fish's 300-megawatt estimate.
Yeah.
But the more illuminating part of his answer was explaining the fundamental difference between how Akamai interacts with the global power grid versus how a hyperscaler interacts with it.
How does the strategy differ in practice?
Well, when a hyperscaler decides to build an isolated AI factory, they might need anywhere from 100 to 500 megawatts of continuous power in one single concentrated location.
That's a huge footprint.
Right. Requesting that kind of load causes massive strain on local municipal power grids. It requires the construction of massive, dedicated substations. It takes years of regulatory approval, and it often triggers intense community pushback over environmental concerns and grid stability.
It's like dropping a massive, energy-hungry manufacturing plant in the middle of a suburb.
Exactly. But Akamai operates in the shadows of the grid. Their core compute locations run on a significantly smaller footprint, typically just 5 to 10 megawatts each. And instead of concentrating that draw in one location, it is spread out across 700 different cities globally.
It's the difference between asking one single power company for 500 megawatts of new generation versus quietly asking 100 different local power companies for just 5 megawatts each.
It flies completely under the radar of the massive grid bottlenecks.
That makes total sense.
And McGowan elaborated further, noting that their traditional CDN delivery and security hardware is already incredibly power efficient. Like a rack of caching servers might only use a few kilowatts.
Right.
Obviously, adding heavy GPU compute increases the draw. But because they are so widely distributed, Akamai is actually viewed as a highly attractive premium client by the operators of third-party data centers.
Why is that?
Because Akamai has pristine credit, they pay their bills on time, and crucially, they are not an existential competitive threat to the data center providers in the way that Amazon or Microsoft are.
Oh, wow. I don't think about that.
Yeah. Because their power needs per site are relatively small, they can easily secure co-location space and the necessary power envelopes in existing facilities all over the globe without triggering the massive multi-year energy grid crises that delay hyperscaler projects. They just rent a fraction of the available power in hundreds of existing buildings.
It is a brilliant logistical bypass. They dodge the massive centralized infrastructure bottleneck by fundamentally decentralizing the physical hardware.
Exactly.
So we have established that this highly distributed network is an absolute powerhouse for running low latency AI applications. It's fast, it's local, it seamlessly navigates the global power constraints. But here is where the narrative of the earnings call takes a very sudden, very dark turn.
Yeah, the tone really shifted.
Because ironically, the exact same AI technology that is creating a massive new revenue stream for Akamai on the compute side is, well, simultaneously creating an absolute nightmare scenario on the open internet.
It's a double-edged sword.
And that nightmare is the catalyst driving their other massive engine of growth, the security business.
The convergence of AI and cybersecurity is completely altering the threat landscape right now.
It really is. I want to frame this section with a direct quote from CEO Tom Layton, because his language in the transcript is remarkably stark.
It was unusually blunt for him.
It was. We are talking about a man who has been at the forefront of internet infrastructure and security for decades. And when discussing the current mindset of chief information security officers, the CISOs, the executives directly responsible for keeping massive global corporations safe from hackers, Leighton said, "I don't think I've ever seen the CISOs more agitated and feeling more of a sense of urgency than they are now."
Yeah. When a veteran of the industry uses words like agitated and urgency to describe the collective mood of global security executives, it indicates a systemic shift, not just, a temporary spike in normal hacker activity.
Right. Let's clearly define the threat vector for the listener. Why are the security professionals suddenly so terrified? What is the actual dark side of the artificial intelligence boom?
Well, the terror stems from the fact that frontier AI models have fundamentally democratized and exponentially accelerated the capabilities of malicious actors.
Okay.
Attackers are no longer just human hackers manually typing code, searching for flaws, and executing attacks one by one. They have weaponized advanced AI to automate the entire life cycle of a cyber attack.
So the AI is doing the hacking.
Yes. They use AI to continuously scan massive, complex corporate networks, rapidly uncover deeply hidden vulnerabilities, and instantly launch automated, highly sophisticated attacks at a scale and velocity that human defenders simply cannot process.
And Leighton specifically pointed out that AI is going to systematically uncover a massive wave of previously unknown vulnerabilities in software code, which leads to an environment that feels like constant, unending zero-day attacks.
And zero-day attacks are the ultimate nightmare for a security team.
Let's pause and make sure everyone understands the mechanics of a zero-day. A zero-day vulnerability is a flaw or a bug in a piece of software that the original software creator does not know exists yet.
Right.
They've had literally 0 days to write a patch or fix it.
Yeah.
So if an attacker discovers that hidden flaw first, they possess a skeleton key. They can walk right through the front door of a corporate network, bypass the alarms, and steal data before anyone even realizes the door was left unlocked.
Exactly.
Historically, finding a zero-day required immense human skill and months of painstaking research. Now, malicious actors are feeding software code into AI models and asking the AI to find the 0 days for them, 24 hours a day, 7 days a week.
And finding the vulnerability is only the first half of the problem.
What's the second half?
The second half is the staggering scale of the brute force attacks powered by AI. Hackers are using AI automation to compromise and take control of millions of unpatchable, unsecured legacy devices connected to the internet.
Like what?
Think about outdated smart TVs, cheat home routers, forgotten Internet of Things security cameras. They aggregate these millions of infected devices into enormous coordinated bot armies capable of launching synchronized attacks.
Wow. Leighton actually shared a specific chilling anecdote during the call to illustrate this scale.
I remember that.
He revealed that just in the few weeks leading up to the earnings report, Akamai's network had to neutralize a series of coordinated application layer attacks that featured millions of highly sophisticated malicious requests per second. Millions of attacks.
Yeah.
Every single second.
It's hard to even fathom that volume.
And they were originating from millions of completely different, widely distributed IP addresses around the globe.
This is the exact scenario that keeps a CISO awake at night. Think about the physics of that on Mac. If you are a major global bank or a massive online retailer and your centralized corporate data center is suddenly hit with millions of malicious, highly complex requests every single second from millions of different computers worldwide, a traditional, expensive hardware firewall sitting in your server room is simply going to melt. It will be completely overwhelmed by the sheer volume of traffic. The network pipes will clog, legitimate customers will be locked out, and the infrastructure will crash.
Which brings us perfectly back to why Akamai is winning so many massive security contracts right now.
Yeah.
It ties directly back to the physical architecture we were just discussing.
Exactly. The only way to stop a massive, highly distributed, AI-driven botnet attack is with an equally massive, highly distributed defense network. You cannot defend against a global swarm from one centralized location.
Right.
Akamai deploys its security software, specifically its web application firewall, or WAF, across those exact same 4,300 edge locations in 700 cities.
So the defense happens at the perimeter.
Exactly. When an infected smart TV in Brazil is commanded by an AI botnet to launch a malicious request at a banking server located in New York, that request doesn't travel all the way across the ocean to hit the bank's firewall.
It gets stopped early.
Right. The Akamai server, located physically in Brazil, intercepts that bad traffic, analyzes the signature, recognizes it as malicious, and drops the connection right there at the local edge of the internet.
Wow.
By neutralizing the threat locally in hundreds of cities simultaneously, Akamai absorbs and dissipates the attack globally. They kill the swarm before the malicious traffic ever has a chance to coalesce, cross the ocean, and overwhelm the target bank.
Listening to this dynamic play out, it forces a deeply uncomfortable question, I think.
What's that?
Is the future of the internet essentially just an endless, highly lucrative AI arms race?
Oh, 100%.
Think about the cycle the attackers are aggressively utilizing AI models to find the invisible cracks in the code and launch these massive coordinated swarms. Therefore, corporate victims are practically forced to buy advanced AI-powered security services from edge providers like Akamai just to hold the defensive line.
It is the absolute definition of an escalating arms race. But as Tom Layton carefully explained on the call, while AI is crucial for identifying patterns and updating defensive rules, AI alone is not a silver bullet for security. No, the ultimate defensive moat, the true replicable advantage that Akamai possesses isn't just a smarter algorithm. It is their physical infrastructure.
Edge again.
Yes, it is the raw, undeniable scale of their global network. You fundamentally need the physical server capacity spread across hundreds of countries to physically absorb and process the sheer staggering volume of attack traffic generated by these bot armies.
The panic in the cybersecurity sector is palpable. And the financial proof of that panic is plastered all over the earnings transcript. The terror of the CISOs is directly driving immense sales growth for Akamai's security division.
It's directly translating to revenue.
During the call, Layton didn't just speak in generalities either. He cited specific, massive security contract wins driven by this exact dynamic. Let's look at the numbers. They recently signed a massive $24 million contract with a major U.S. retailer. And the context is fascinating. They secured that massive commitment specifically because Akamai's network stepped in and successfully protected that retailer from a devastating coordinated bot attack during the critical holiday shopping season.
Wow, during the holidays, that's life or death for retail.
Exactly. They essentially kept the digital doors open, saved the holiday revenue, and the retailer immediately signed a $24 million check to make sure they stayed protected permanently.
The scope of the deals is expanding across every industry, too. Layton also highlighted a massive $80 million expansion contract spread over 2 years with a major video game company.
I found that detail fascinating. Why does a video game company require $80 million worth of cybersecurity infrastructure?
Well, think about the mechanics of modern, massive, multiplayer online games. They are massive digital economies, and they are incredibly fragile.
True.
They are constant, lucrative targets for malicious actors, launching DDoS attacks to extort the developers, deploying botnets to steal valuable user data, or running automated, AI-driven scripts to manipulate and cheat the in-game economies.
Oh, wow. I didn't even think about the bots cheating.
Right. And for a gaming company, a few milliseconds of latency completely ruins the player experience, and a successful attack that takes the servers offline or compromises player data permanently destroys the company's reputation and revenue stream. They absolutely require that localized, edge-based protection to keep the game fast and secure.
That makes total sense.
Layton also pointed to a $20 million expansion deal with a global consumer electronics company based in Korea. So the demand for enterprise-grade edge security is surging uniformly across every major sector of the global economy.
Okay, so we have established the two massive roaring engines of growth driving this company forward. The Cloud Infrastructure Services division is being fueled by the demand for distributed AI computing, highlighted by the massive $1.8 billion mega deal.
Right.
And the security business is accelerating rapidly, fueled by terrified corporate executives desperate to protect their networks from AI-powered bot armies. Now, let's look forward.
Let's do it.
Let's examine how the executive team is guiding Wall Street's expectations for the remainder of 2026. And crucially, we need to understand the financial engineering behind how they actually plan to pay for this incredibly expensive physical expansion.
Because management guidance is the ultimate reality check on an earnings call. It is where the visionary narrative meets the rigid constraints of accounting. CFO Ed McGowan methodically laid out the financial projections, starting with the immediate future in Q2 2026. They are projecting total overall revenue to land somewhere in the range of $1.05 billion to $1.1 billion.
Solid.
For profitability, they are guiding for non-GAAP earnings per share to be between $1.45 and $1.65.
Those are steady, respectable numbers.
Yeah.
But the metric that absolutely jumps off the page, like the number that tells the real story of the transition, is the CapEx projection for the second quarter.
Oh, yeah, that's the one.
They informed investors to expect a significant, massive spike in capital expenditures, projecting an outlay of somewhere between $433 million and $453 million in a single quarter.
$500 million.
That translates to roughly 40% to 41% of their entire total revenue being immediately plowed right back into purchasing physical hardware and infrastructure.
And McGowan provided the specific context for that massive cash outflow. Q2 is the quarter when the massive orders for the specialized NVIDIA GPUs finally start arriving at the loading docks.
The bills come due.
That is when the massive invoices come due for the hardware required to actually build the infrastructure to service the $1.8 billion contract and the other massive cloud deals they've signed. The theoretical pivot becomes a physical reality, and physical reality is expensive.
Very expensive. After addressing the immediate quarter, McGowan zoomed out and provided the full year 2026 outlook. Total revenue for the year is expected to land solidly between $4.45 billion and $4.5 billion.
Right.
But the specific segment guidance is what I find fascinating because it perfectly mirrors the narrative of the three pillars we discussed at the top of the deep dive. The legacy delivery revenue, expected to continue a slow, managed decline in the mid-single digits.
As planned.
The massive security revenue, expected to continue growing steadily in the high single digits. But the cloud infrastructure services division.
This is where management planted a massive flag in the ground. They confidently raised their full-year outlook for the CIS division, projecting it will achieve at least 50% year-over-year growth in constant currency.
At least 50%.
That is a hyper-growth trajectory sustained over an entire fiscal year.
However, buried within this very optimistic guidance, Ed McGowan delivered a very subtle, highly nuanced, yet incredibly bullish warning to the analysts regarding their future capital expenditures.
Yeah, this was interesting.
He was a masterclass in expectation management. What was the surprise he hinted at?
Well, McGowan carefully noted that the sheer market demand they are currently seeing for their cloud infrastructure services, specifically the demand from enterprise clients desperate to run AI inference on distributed GPU networks, is absolutely exceptional.
Okay.
The current pipeline of potential clients clamoring for edge-based GPU capacity significantly exceeds both their current physical inventory and the projected inventory they already have on order.
Wait, let me translate that dynamic. They have more highly funded tech companies knocking on their door wanting to rent AI computing power than they have actual AI computers to rent out.
Exactly. They are structurally constrained by their own physical supply.
It is a phenomenal problem to have, but it's still a problem that requires capital to solve.
Yes, it does.
So McGowan issues this subtle warning to the analysts modeling the company's cash flow. He says, we may place additional GPU orders in the second half of the year to meet this demand. This potential expense is not factored into our current annual CapEx guide of 40% to 42%.
Which is huge.
He is essentially communicating to Wall Street, look, I am officially telling you to expect us to spend roughly 40% of our revenue on capital investments this year. But if our sales team continues to sign these massive, highly lucrative AI deals at this pace, I'm going to be forced to spend hundreds of millions of dollars more to buy the necessary hardware, and I will alert you when that happens.
It's a great warning to have to give.
It is a staggering position to be in. But let me stop the analysis right there, because I want to challenge a glaring contradiction in the financial strategy.
Okay, let's hear it.
Let's look at the logic.
Oh.
You have a sales pipeline that is so incredibly hot, so demanding of physical infrastructure, that your CFO is openly warning analysts that he might need hundreds of millions of dollars in unexpected capital expenditure just to buy enough microchips to satisfy the clients.
Right.
If you are in that position, an all-out land grab for the future of AI infrastructure, why on earth is the company spending cash on anything else? Because later in the transcript, they discuss their capital allocation strategy.
Yeah.
They proudly note they have a strong balance sheet with $1.7 billion in cash on hand and access to a $1 billion line of credit.
Yeah.
And yet, amidst this massive cash-hungry pivot, they reveal they spent $206 million this quarter buying back 2 million shares of their own stock on the open market.
Yeah, they did.
Why would you ever spend over $200 million repurchasing your own stock when every single available penny should be aggressively deployed to secure more NVIDIA chips and capture more market share? doesn't make sense.
It is a fantastic question, and it highlights a deeply complex dynamic that almost every mature, publicly traded technology company must navigate. It illustrates the incredibly delicate, high-stakes, tightrope walk of a modern CFO.
Okay, explain it to me. Why initiate stock buybacks when you have an insatiable operational need for raw cash?
Well, Ed McGowan explained that their primary intention with this aggressive capital allocation strategy is to consistently buy back shares to offset the inevitable dilution caused by their employee equity compensation programs over time.
Let's unpack the concept of equity dilution for the listener, because it is the hidden engine of the Silicon Valley economy.
It really is.
When you are a highly competitive tech company like Akamai, trying to build a cutting-edge AI and security network, you need the absolute best software engineers, data scientists, and specialized sales executives in the world.
And they are expensive.
And you cannot attract or retain that tier of talent with just a cash salary. You have to pay them in stock options. You have to give them ownership in the company so their incentives are aligned with the company's growth.
Right.
But every time the company issues new, fresh shares of stock to pay a brilliant new engineer, it artificially inflates the total number of shares that exist in the world. And by the simple laws of supply and demand, increasing the supply of shares mathematically dilutes or reduces the value of all the existing shares held by your outside investors.
It is a hidden tax on the shareholders, essentially.
Exactly.
So the CFO employs a mitigation strategy. He takes a portion of the actual cash generated by the business and uses it to go out into the open public market and buy back those shares. Once the company repurchases those shares, they are essentially retired and removed from circulation.
Ah, I see.
The ultimate goal is to buy back exactly enough shares on the open market to perfectly offset the new shares they're constantly printing to pay the employees. This keeps the total overall share count flat. It neutralizes the dilution, which is absolutely vital for keeping traditional legacy shareholders from revolting.
It's an incredible balancing act.
Yeah.
You have to remember the history of Akamai's shareholder base. They have a massive block of legacy institutional investors who originally bought into the stock because it was a steady, predictable, highly profitable, cash-generating content delivery business.
Right. They want those dividends and high margins.
Those investors expect stability and margin preservation. So Ed McGowan has to constantly placate that legacy base with share buybacks to protect their equity value, while simultaneously, quietly, betting the absolute future of the entire company on an incredibly capital-intensive, high-risk transition into a hardware-heavy AI infrastructure.
He is aggressively funding the disruptive future while meticulously maintaining the strict financial discipline demanded by the legacy investors of the past.
It requires immense financial discipline to not let either side of the equation collapse.
Completely agree.
Let's pull all of these complex threads together. We are nearing the end of our analysis, and I want to synthesize the entirety of this earnings call for you listening. We want to construct a clear, objective, and deeply considered view of what all these numbers, narratives, and strategies signal for the ultimate future of Akamai.
Let's weigh the evidence.
Yeah, let's look at the bull case for the stock and the bear case against it. Let's start with the optimists. Why do the bulls look at this Q1 transcript and see a massive, historic victory lap?
The overarching bull case is that Akamai is currently demonstrating the ability to successfully execute one of the most notoriously difficult maneuvers in the entire history of the technology sector.
Pivoting a giant.
Yes. They are successfully pivoting a legacy, slowly declining cash cow business, the content delivery network, and seamlessly transitioning that massive global footprint into the two absolute hottest, most lucrative sectors on the planet: distributed AI inference compute and next-generation AI-driven cybersecurity.
It is incredibly rare to witness a legacy tech giant actually pull off a pivot of this magnitude. Usually, when a company's core market matures and begins to decline, the company becomes paralyzed by its own bureaucracy and simply fades slowly into irrelevance, eventually being acquired for parts.
We've seen it 100 times.
But Akamai didn't just pivot on paper. They proved they can actually win in the open market against the most terrifying competitors on Earth. That $1.8 billion contract with the Frontier Model Company is the ultimate, undeniable market validation.
It really is.
It emphatically proves that Akamai can legitimately compete with and outright beat the seemingly invincible hyperscalers like Amazon, Google, and Microsoft when the battleground shifts to the edge of the network. They possess a unique physical infrastructure advantage, 4,300 deeply embedded locations, and they're leveraging that legacy footprint beautifully to offer a highly differentiated product. Ultra-low latency ICAC compute paired with massive scale localized security.
The bull argument is that they have fundamentally reinvented the company's growth engine for the next decade.
Absolutely.
However, an objective analysis demands we look at the immense risks involved. There is a very real, very potent bear case to be made by the skeptics looking at this exact same set of numbers.
Right. What are the institutional bears focusing on?
Well, the core of the bear case centers entirely around the sheer crushing financial gravity of this operational transformation. The bears argue that this pivot is simply too capital intensive to sustain high valuations.
Okay.
Think deeply about the fundamental business model shift we have been discussing. For 2 decades, Akamai generated high margin, low capex revenue by routing software and data. Now, they are aggressively trading that elegant software model for a distinctly hardware-heavy, logistics-heavy business model.
Right.
They were taking on the massive burden of purchasing, maintaining, and eventually replacing billions of dollars worth of rapidly depreciating GPU infrastructure.
The shift in margin profile is severe. When you sell a pure software security product or a CDN routing service, the gross margins are incredibly lucrative because the cost of delivering one additional unit of software is practically zero.
Exactly.
But when you are contractually obligated to spend $800 million acquiring highly specialized physical NVIDIA graphics cards that run incredibly hot, consume massive amounts of power, and will inevitably become technologically obsolete in a few short years, your profit margins get absolutely crushed by the weight of physical depreciation.
And we are already seeing the initial impact of this in the current financials, with their operating margins compressed down to the 25% or 26% range. The bears question whether a hardware-heavy infrastructure company deserves the premium valuation multiple of a high-margin software company.
And beyond the pure financial margin compression, there is an immense, unquantifiable layer of execution risk. It is one thing for a CEO to stand on a stage and confidently announce a plan to deploy thousands of advanced GPUs globally. It is an entirely different, staggering logistical nightmare to actually execute that plan in the physical world.
Oh, the logistics are terrifying.
They have to physically procure, ship, install, supply power to, heavily cool, and flawlessly network thousands of delicate, incredibly expensive GPUs across 700 different cities, navigating hundreds of different municipal regulations and supply chain bottlenecks seamlessly.
Yeah.
If the global hardware supply chain hiccups, or if there's an unforeseen flaw in how they network the distributed inference models, that massive $1.8 billion guaranteed contract could very rapidly morph into a catastrophic liability.
That is the ultimate tension defined in this transcript. It is an incredibly high-reward transformation aiming for dominance in the next era of computing, but is built on a foundation of very high-risk, capital-intensive physical execution.
But before we bring this deep dive to a close, there's one final truly fascinating detail from the Q&A session that I think perfectly bridges the gap between their legacy business and their AI future.
Oh, I love this part.
It was sparked by an incredibly insightful question from an analyst named Indosanjit Singh, and it centers entirely on the fate of the legacy delivery business.
This was absolutely my favorite conceptual moment of the entire earnings call.
It's so good.
The analyst looks at the grand vision Tom Layton is painting and essentially asks a brilliant logical question. He says, wait a minute, let's play this out. If the entire future of the internet is going to be populated by millions of autonomous AI agents constantly running around the web, independently browsing sites, calling external tools, scraping data, and executing complex tasks on behalf of human users,
Right.
won't that massive explosion in automated activity cause a massive unforeseen resurgence in sheer data traffic for your traditional legacy CDN delivery business? Aren't the bots going to save the old business?
That's a highly logical assumption, because if you drastically increase the number of entities, human or AI, interacting with the internet, you increase the volume of traffic that needs to be delivered. But Tom Layton's response was incredibly nuanced and grounded in the reality of data transmission. He openly admitted that yes, a significant portion of internet traffic that used to be generated by humans clicking links will inevitably shift to being generated by autonomous agents. However, he quickly pointed out that an AI agent executing a simple web search or scraping a text-based database simply doesn't move the needle on overall data volume.
Right, because text data is incredibly tiny. Sending 1 million text-based queries across a fiber optic cable requires almost zero actual bandwidth compared to streaming a movie.
Exactly. But then blatant pivots. He points directly to the specific technological advancement where the real exponential traffic explosion is likely to happen, and it isn't text, it is generative video.
He painted an incredibly vivid, futuristic picture of e-commerce. Imagine you go to a major retail website, you are browsing, and you click on a specific sweater. Today, you look at 3 or 4 static, pre-compressed JPEG photos of a model wearing that sweater. But in the near future, powered by edge AI compute, the moment you click that sweater, a local AI agent instantaneously generates a personalized, high-definition, real-time video showing a digital avatar that looks exactly like you, walking around demonstrating exactly how that specific sweater fits your body type.
Wow. Think about the implications of that shift on the architecture of the internet. If every single online shopper across thousands of retail sites globally starts casually generating personalized, real-time, high-definition video streams for every single individual item they click on, the total volume of data traveling across the global internet will skyrocket exponentially.
It will dwarf the bandwidth currently used by traditional streaming services.
And with that massive tsunami of generative video data needs to be delivered from the local edge compute server directly to the shopper's smartphone without buffering, who delivers it? It flows directly through Akamai's legacy content delivery network. The new AI compute business essentially acts as a massive demand generator for the old plumbing business.
Leighton acknowledged that we are still in the very early experimental days of generative video commerce. It absolutely possesses the potential to generate a massive, unexpected resurgence in their legacy delivery traffic.
But he was cautious about it.
He remained highly disciplined in his strategic hierarchy. He was very clear to investors. The absolute biggest driver for future growth and capital allocation is the AI compute platform. The second biggest driver is the security business protecting against the dark side of that AI.
Right.
The legacy delivery business remains highly synergistic. It generates the massive free cash flow required to fund the expensive physical build-out of the new operations, and it may very well see a massive, unexpected volume bump from AI-generated video. But make no mistake, the real money, the fundamental future valuation of the company, is entirely dependent on securing dominance in edge compute and edge security.
Let's take a collective breath and recap the sheer scope of the journey we just took. We started by opening relatively dry, standard Q1 earnings report for a legacy tech company, and we ended up deeply dissecting the physical architecture of a multi-billion-dollar global AI arms race.
It's wild.
We watched a company that built the invisible plumbing of the 1990s internet morph into a critical, heavily armed vanguard of the artificial intelligence revolution. We saw them sign the largest, most complex dedicated capacity deal in their history, commit to spending nearly $1 billion on raw NVIDIA hardware in a single year, and actively defend the global economy against millions of malicious, AI-driven bot attacks every single second.
It serves as a profound masterclass in corporate evolution. It is entirely driven by the fundamental realization that artificial intelligence cannot simply exist in a centralized, abstract vacuum in the desert.
No.
To be truly effective, to be responsive, and to be secure, the massive computational power of AI must be physically pushed out to the absolute edges of the network, woven directly into the fabric of the cities where the end users actually live.
Which brings us to our final thought. I want you to take this concept and mull it over long after this deep dive ends. For the last 3 years, ever since the generative AI boom truly began, the dominant, pervasive narrative in the technology sector has been entirely about the centralization of power.
Completely.
We constantly hear about the massive trillion-dollar hyperscalers, the Microsofts, the Googles, the Metas, spending tens of billions of dollars building gargantuan supercomputers in remote locations, relentlessly pooling all the world's data and all the world's electrical power into a few centralized hubs just to train these massive frontier models.
The AI factories.
But what if the accepted narrative is wrong? What if the next 10 years of the AI revolution look fundamentally different? What if the future of how we actually use AI is entirely decentralized? If the true transformative power of AI relies on personalized, autonomous agents running seamlessly on your smartphone, analyzing live video feeds in your local coffee shop, or processing complex logistics at a cell tower a mile down your road, does the ultimate defining power in the tech industry begin to shift?
That is the question.
Does it migrate away from the companies that own the giant isolated data centers and flow back to the agile companies that physically own the edge of the network?
That is the multi-billion-dollar strategic question that will define the next decade of infrastructure investment.
And that is exactly where we will leave the conversation for today. Thank you for taking the time to join us on this exhaustive deep dive into the complex financials, the shifting narratives, and the highly contested future of the internet's invisible plumbing. Keep pushing beyond the headlines, keep questioning the complex mechanics behind the numbers, and we'll see you next time.